Hey everybody, how is it going? Welcome back to the channel. Well, another down day in the market. What a shock. But even though things look rather bleak out there, I am feeling rather optimistic. Call me a crazy person, call me a hopeless optimist, just don't call me late for dinner. But I happen to think that we are probably going to be all right here. I think we're going to have a tightening cycle, kind of like this one right here that we had in the mid 90s that did not cause a recession. As you can see, most of these tightening cycles do end up, causing a recession. These shaded areas are the recessions. And sometimes we can have these tightening cycles where it does not cause a recession. And I'm kind of thinking, that's what we're going to be in right now. It doesn't look like it right now, but, central banks are tightening monetary policy for sure. And thus they're actively trying to reduce asset prices, consumer demand, and money creation in order to tame price inflation. Now, this tends to be a challenging environment for stocks and real estate, either in terms of just big downward moves or in terms of volatile sideways consolidations. And that being said, there are times where the market can get ahead of itself and become too bearish too quickly. And I think that's kind of the situation we are in right now. But there can be significant rallies along the way as well. But the Fed is in hopes of, engineering a soft landing, meaning they want to reduce marginal demand just enough so that it cools off from overheated levels, but does not cause an outright recession. Now, while this is possible, we can see that the historical record of achieving this is not very good. They typically tighten monetary policy until a recession occurs. And, this chart shows the Fed interest rates with the recessions shaded in gray here. But most likely the Fed's going to tighten monetary policy until something breaks, which will force them to reverse course. Now, it might be a recession or it might just be more of a slowdown. All right, so the next chart I want to go over is also from the Federal Reserve's website, and this one just shows the relationship between the 10-year Treasury minus the 2-year Treasury. So the 10-year Treasury minus the 2-year Treasury, and then the 10-year Treasury minus the 3-month Treasury. The blue line is the 10-year Treasury minus the 2-year, and the red line is the 10-year Treasury minus the 3-month Treasury. Now, it seems like on TV they talk about the relationship of the 10-year Treasury minus the 2-year more often, and then they talk about the 10-year Treasury minus the 3-month, even though I think the 10-year 3-month is a little bit more predictive. But the 10-year 2-year, the 10-year 2-year Treasury yield curve did briefly invert, and the 10-year 3-month yield curve is likely to catch down to it eventually if the Fed keeps raising the short end interest rates. Now, most stock prices and real estate prices have kind of stagnated over the last year. I know some stuff is down, but bond prices have definitely had their worst sell-off in decades. But looking at this relationship that we have currently going on right here, you can see that they're kind of moving away from each other, and this kind of reminds me of what was going on in the mid-90s, and eventually you can see the red line, it catches down to the blue line. Now, this was the time when we had them diverging, but it did not cause a recession until, after the year 2000. And I don't know, I'm just thinking that's the way that this is going to end up playing out, but it's probably going to be pretty darn close. But either way, I think it's going to be a pretty good buying opportunity for stocks. And if we take a look back at the S&P 500 during the mid-90s rate tightening cycle, we can see that the S&P 500 kind of, fell off a cliff during the beginning of the tightening cycle, and it was very choppy going forward. You can see it carved out a little bit of a bottom during April, May, and June before it started to rally, but then it rolled over again into the end of the year until finally the next year we got into a nice sustainable rally. And I'm kind of thinking that this is the way this market is going to play out. Now, it could end up going sideways or even a little bit lower in the short term, but I do think eventually, we're going to end up getting another bull run out of this. I think a lot of valuations have come back. Now, this doesn't mean that a lot of these, high growth, cash burning operations are going to participate in this rally. I think you need to focus on quality when we do come out of this pullback that we're in. But I am optimistic that this is not going to end up being a multi-year bear market. And even if we do get a recession, I'm still kind of thinking that it's going to be a light one. All right, so let's get into some of these current market indice charts and see what they are looking like. But before I get into any of this crap, please remember, I am not a financial advisor. I'm not recommending any of this stuff. I'm just trying to give you my current thoughts and opinion on what's happening right now. But let's take a look at the QQQ, which of course is the ETF for the NASDAQ. And as we can see, the QQQ or the NASDAQ is really starting to accelerate to the downside. It's really starting to fall off a cliff. We got higher than average volume these last several days, so you're starting to get that climax sell coming into the market. I do think that it's probably going to get worse. Probably need one more big, massive down day at least before we get a final washout in this market. And a couple of stocks that I've been watching closely, thinking that once these break down, we're probably going to finally get that massive selling. Look like they might finally be starting to break some support. Let's start with Apple. We can see Apple is coming right down into the support area, but it's breaking this support area right around 155 down to about 152 at the moment. If it breaks through this support level, I think the bottom could drop out of Apple, and that is going to be not good for the market. We'll just say that. And another one is Microsoft. Microsoft, I think once Microsoft really starts to break down, the market's going to be in big trouble. You can see Microsoft is breaking this support area with authority today. So I think all the conditions are set up for a final blow-off, move to the downside, and then we can get a sustainable, multi-week rally to the upside. Now, whether that ends up being, the absolute bottom in this, I have no idea, and I would guess it's probably not, but we are overdue for a multi-week rally to the upside. So it just seems like we are getting just about set up for that final sell-off. We can see the S&P 500 or the spider is really starting to accelerate to the downside, starting to get some more volume come in on the spider. So the spider is getting close. Now, probably the Dow is holding up better. Well, I don't know. The Dow looks like it's kind of accelerating to the downside as well. So all these conditions are set up for that final move. I will be buying a big sell-off for sure. And I know those are tough to buy, but you just kind of have to hold your nose and do some buying. But looking at the IWM certainly breaking down from this consolidation very, very, very quickly, and not overwhelming volumes. That's why I'm just thinking that we have some more time. And plus, with Apple and Microsoft just starting to break down, makes me think that we have some more selling ahead of us. Let's take a look at some of the commodities. Let's take a look at oil first, because I was noticing that a lot of energy names were starting to sell off today pretty hard. So that's one good thing that could happen with this sell-off. I think it's going to end up taking down some pretty good energy names. So if if you're in the same opinion I am that we could be heading into a multi-year commodity, some people call it a super cycle, just a multi-year bull run for some of these commodities that have been suppressed for so long. This could be a pretty good opportunity, to identify some good energy names, to add to your portfolio if you do want some more diversification to that side of the market. But let's take a look at gold. I think gold was breaking down. Yes, it was. Getting pretty close to that 200 period simple moving average. I would expect a bounce right there. And taking a look at silver. Silver is really falling off a cliff, especially compared to gold. The silver to gold ratio has to be pretty wide. I'm going to have to check that out after this video. But normally when gold gets more, the ratio between the price of gold and silver gets too wide, you usually end up getting a snapback pretty hard in the price of silver versus gold, and we got to be getting pretty close to that normal area of where it tends to snap back for silver. But I'll have to look into that. But man, a lot of these things are really starting to break down, so it's time to start getting those buy lists in order. All right, well, before I close out the video, I just want to show you some of the names at the top of my wish list. I haven't bought any of these yet, but if the market continues to accelerate to the downside, I might buy some of them or maybe even all of them this week. Now, please don't buy any of these just because I'm putting them in the video. Please do all of your own due diligence. But first one I want to start off with is Micron Technology. I've talked about this one a couple times in the past, but as you can see, Micron Technology was down about 3.5% today, down to $67, so getting super close to my buy zone. And as you can see, the factor grades are all A's and B pluses, so this one is rated very highly. The Seeking Alpha authors rated as a buy, Wall Street and the quants all rated as a strong buy. just started paying a dividend. It's at 0.43%. Not very high, but they just started paying that, and I think they're going to have the ability to raise that substantially in the future. But Micron is looking pretty good right here. Another one I like is qcom, Qualcomm. You can see Qualcomm also rated relatively highly, a little bit lower than Micron, but Seeking Alpha Authors and Wall Street all rated as a buy, and the quants rated as a strong buy. Now, Qualcomm's been paying a dividend for a little bit. It's about 2.13%. I think Micron's probably going to have theirs up to over 2%. Before too long, give them a few years, but I think they definitely have the ability to get up to at least a 2% yield in the future. You can see Qualcomm down to 134, down 4% on the day, or $5.66. So this thing gets down to around 125. I'm definitely going to be dipping the toe in the water with Qualcomm. I think Qualcomm has a pretty bright future ahead of it, but let's get into some of those energy names. First one I want to talk about is CTRA, which is Katera Energy. This one was down 10% today. I probably should have been adding this one. They have a yield of 1.84%, but I think this company is profitable with oil right around $40 a barrel. So as long as oil stays anywhere near where it's at right now, this company is going to be printing money in the future. You can see with their factor grades, they get all A's, 1B, except for the valuation. It's had a heck of a run up, so I've been waiting for a pullback, but as you can see, it's down to 10% today, so decent pullback into this one and a lot of other energy names. Another one I like here is SU. That's the wrong one. How about SU? Let's try that. Sun Core Energy. This one was down 6% today. It has a yield of 3.5%, but you can see factor grades are all very high except for valuation. Some of these oil names got a little bit ahead of themselves. I'm just waiting for some kind of a meaningful pullback in some of these names, before I add another energy stock to my portfolio. But you can see in the rating summary, it's all rated as buys and strong buys. So Sun Core Energy, I really like. Another one is Continental Resources, CLR. This one was down 11.5%. I wasn't even looking at some of the oil names over the last couple of hours, so we can definitely see that they accelerated to the downside. Factor grades of all A's and B's, except of course for valuation. So when you see something like this, just try to identify a pullback zone that you're comfortable with. But you can see it's rated as buy, hold, and a strong buy. They have a yield of 1.8%, and at these levels of oil, they are going to be printing cash as well, so they should be able to raise these yields up in the future. Next one was BSM. I think this one was down quite a bit today as well. Blackstone Minerals was down almost 5%. They have a yield of 5.8%, but as we can see, they are rated as buy and strong buys. They have a factor grade for growth of C, but everything else is either an A or B. So even the valuation on BSM really isn't too bad. So if we get a pullback in the market, I do think that Blackstone Minerals is going to look very attractive. And one that I just can't seem to get off my list. I don't know why, because I don't like the way these shoes look at all, but for some reason Crocs is just looking very interesting at these levels. It was down 11% today, down to $54 a share. You can see their forward PE is down to 5.81. I would probably be a little bit more excited about this company if I didn't think the shoes looked ridiculous, but everybody has a pair of these things. But that being said, the fashion industry can be very cyclical and fickle. So I usually don't buy stocks like these just because you never know what the future is really going to hold for these things. But it just seems like everybody's wearing these stinking things. But has a rating summary of buy, and hold. Their factor grades are B, C, A, D. Obviously D is because they've been trending down, so I'm not as worried about that one, but they have been revising earnings actually up, so it's pretty decent looking entry point right here. But those are the ones that are on my watch list. And if you guys see anything interesting, or if you have anything interesting on your watch list, maybe if I missed something decent, put it down there in the comment section. I would really appreciate it. But I'm going to end the video right here. I think I made this drag on too long as it is, but thank you so much for watching all the way to the end. Until next time, in this trading environment, take care, everybody.